So if you've glanced at the markets recently, you probably felt that little bit of vertigo. Stocks, gold, silver, it feels like everything's falling all at once, doesn't it? But this isn't just random chaos. There are some really powerful forces at play here. Everything from clogged up global money pipelines to the massive uncertainty around one single person. So let's dive in and unpack what's really going on behind this global sell-off.
I mean, this quote just nails the feeling right now, doesn't it? After those huge drops last week, the turbulence is just continuing. What we're seeing is something called a system-wide deleveraging event. And that's just a fancy way of saying that investors are being forced to sell their assets to pay down debt. And they're all doing it at the exact same time. But to really get why it's all happening so incredibly fast, we need to look at a key mechanism that's basically twisting their arms.
The trigger for this kind of lightning-fast, forced selling is often that dreaded phrase, the margin call. See, when investors who've borrowed money see the value of their stuff just plummet, their brokers call and demand more cash, like right now. If they can't cough it up, the broker just starts selling their assets for them to cover the losses, which of course pushes prices down even further for everyone else. And this is happening on a massive scale right now because of a very specific plumbing problem in our global financial system.
And what's wild is that this isn't just about people panicking, it's a mechanical failure. Okay, so picture this. A big drop happens during Asian trading hours. Margin calls start flying out. Investors are scrambling to wire US dollars to cover themselves, but here's the catch. Those wires have to clear through New York. Because of the time difference, the money just doesn't get there before the 10 a.m. deadline in places like Singapore. So the brokers have no choice. They have to start liquidating, which creates this waterfall of selling. It's a liquidity squeeze, and it's being driven by the very pipes of global finance.
So what's causing all this deep, underlying uncertainty? It's not a war, it's not some natural disaster. No, the entire investment world is basically holding its breath over the potential actions of one single man, the nominee for the next chairman of the U.S. Federal Reserve.
And that man is Kevin Warsh. He is the president's pick to take over what is arguably the most powerful economic job on the planet. And because his vision for policy is so different and frankly so ambitious, the market has absolutely no idea what to expect. And this vacuum of certainty, well, that's what's fueling all the fear we're seeing right now.
And look, this is not something that's going to be resolved overnight. We are in for a multi-month period of just peak uncertainty. First, he has to face congressional hearings where he's going to get grilled on his plans. Then he still needs to be confirmed by the Senate. It is not a done deal. And until he officially takes over in June, if he's even confirmed, the market is just going to be trading on rumors and fear.
But the real question hanging over his nomination, the one that goes beyond just dollars and cents, is this. With his, let's call it a surprising family connection to the president, investors are all asking, is the Fed going to stay independent, or will it start to bend to the will of the White House?
Okay, and this is where the political dynamic gets so incredibly important. Warsh's father-in-law isn't just any supporter. He is a close, behind-the-scenes advisor to the president, who personally recommended Warsh for the job. Now, we all know the president desperately wants interest rate cuts. So you can't just slap a simple label on Warsh like hawk or dove. There's this powerful political layer here that makes his next moves incredibly difficult to predict.
So let's actually peel back the layers and look at his philosophy. Because when you dig into what Warsh himself has actually written, you find this fascinating and honestly, deeply contradictory economic plan. He is planning a high-wire act that could either supercharge the economy or send it tumbling off the cliff. This quote, I think, gets right to the heart of how he sees the world. He basically believes the Fed has been using these old, outdated models for a new economy. And the result? A system that pumps up Wall Street assets, making money super easy for them, but starves the real economy, workers and innovative companies, of the money it actually needs to grow.
So his solution to fix all this is a really radical two-part plan. And at first glance, these two parts seem to be in direct opposition to each other, which is exactly why the market is so on edge. Okay, so here is the Warsh paradox. On one hand, he wants to cut interest rates to fuel this massive AI-driven productivity boom. And hey, the market loves rate cuts, right? But on the other hand, he wants to shrink the Fed's enormous $6.5 trillion balance sheet, which means pulling trillions of dollars out of the financial system. That is monetary tightening, and the market typically hates it. So how on earth can you possibly do both at the same time?
His answer? The secret sauce, the absolute linchpin of this entire strategy. It all lies in bank regulations. He plans to unleash the power of private banks to step in and replace the money that the Fed is pulling out.
So he's targeting a global banking agreement called Basel III. It was put in place after the 2008 financial crisis, basically to stop banks from taking on way too much risk. He sees it as too restrictive, forcing banks to keep these huge piles of cash just sitting on the sidelines. His big idea is that by loosening those rules, U.S. banks can finally pump that cash back into the economy as loans. So in theory, this new private lending would perfectly cancel out the Fed's tightening.
But wow, that is a multi-trillion-dollar tightrope walk. I mean, think about it. If he pulls out too much money from the Fed before the banks really start lending, he could trigger a crash. But if the banks lend too recklessly, he could just create another financial crisis down the road. The risk of a misstep is enormous, and the market is pricing in that risk right now as we speak.
So given this backdrop of just extreme uncertainty, how can an investor even begin to think about navigating the next few months? Well, instead of trying to predict the outcome, which is impossible, let's look at a framework for just preparing for multiple possibilities.
Now, let's be super clear. This is just one example of a personal allocation. This is not advice, but it's built around a very clear logic. You can see it's heavily weighted towards what could go right, while also holding a pretty significant amount of protection in case things go very wrong.
Let's break down the why behind this. The biggest slice, AI infrastructure. That's a bet that Warsh's pro-growth vision actually succeeds. Energy? Well, that's a bet on the fundamental power you're going to need for that revolution. But then, you've got precious metals as a direct hedge. It's basically an insurance policy against failure. And maybe most importantly, you have a big pile of cash. Those are your bullets, your dry powder to deploy when fear is at its peak and everybody else is selling.
You know, at the end of the day, navigating an environment like this is less about the specific assets you pick and much, much more about the psychological framework you bring to the table. It's really about controlling your own reactions.
It is so easy to get tunnel vision, to act like a single-celled amoeba that just reacts to one thing, like an interest rate cut. But real investing is about understanding how all the different pieces fit together. The long-term tech trends, the short-term policy messiness, and the global flows of capital. You have to see the entire board, not just one piece.
This is such a powerful distinction. When the markets are tanking, the amateur investor panics. They're only focused on the falling price. The experienced investor, though, stays calm and asks a different question. Has the fundamental logic of my investment changed? Is this still a great company, just temporarily on sale?
So the big takeaway here is this. Your best defense against chaos is a plan you created when you were calm. Allocate your money based on a clear logic. Don't ever use excessive leverage that can force your hand at the worst possible time. Hold cash so you can turn other people's panic into your opportunity. And when the storm hits, trust the health of your assets, not the fear you see in the headlines.
And you know, this really brings us to a much bigger question. In an era of such profound technological and financial change, what does it even mean to be secure? When your job and your paper assets feel like they're at risk, it really forces you to think about what has real, lasting value.
So let's end with that thought. The market is always going to have these periods of chaos and fear. The ultimate challenge isn't beating the market, it's mastering your own response to it. The real test is whether you can let your logic be the loudest voice in your head when your fear is screaming at you to run for the hills.
you.